That sound you heard this morning was the door slamming shut on that rate cut for June. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. We were waiting for action, and that number did not disappoint.
Absolutely. We got a lot to talk about today.
We did. Let's get right to it. So you're looking at S&P, not around the lows of the session, but getting darn close, off by about 1.3%. All major sectors within the S&P in the red, except for energy. We'll get to that in just a moment. 10-year yield up by 20 basis points. Nothing like what we're seeing in the front end, but we haven't seen this kind of move since back of September of 2022. Take that. Also, dollar yen, watching that because we're almost at 153, a huge move that we've seen just today. Will we hear now more intervention talk? And also, honestly, what can Japan realistically do about that? And I mentioned crude up by over 1%. There are reports that potentially the U.S. and its allies now believe that a major missile or drone strike by Iran or its proxies could happen against Israel. Oil spiking, and as I mentioned, Romaine, those energy stocks now making a run for the green.
Yeah, a lot to chew on today, but of course we are going to spend a lot of time on that CPI report because if there was any real sort of debate left out there about whether disinflation had hit stall speed back in January and back in February, that March CPI report this morning removed all doubt. 3 straight times now we've had a key monthly inflation metric coming in hotter than economists forecast, and 3 straight times we've seen a big sell-off in treasuries. Today being the worst, a 23 basis point bump on both the 2 and the 5-year yield. A sobering reminder out there right now about just how lopsided the trade around rate cut expectations had gotten. The swaps market also repriced today with the December contract reaching about 4.85%. That's less than 50 basis points lower than the effective federal funds rate as it stands today. No surprise then that the worst performing stocks today are also the most rate sensitive. The S&P 500 real estate sector having its biggest decline going back to June of 2022. The Philadelphia Utility Index at one point was down the most since October, and home builders erasing almost all of their gains from the past month. The S&P as a whole breaching its 20-day moving average, and the Russell 2000 now back below its 50-day, down about 3% here as we start the show. And remember, it's not just that inflation is persistent. It's the fact that economists and the market for weeks now, refuse to take off the rose-colored glasses and acknowledge what most American families have been saying all along. The rent, the groceries, the clothes, the gas, the electricity, easy for you to say, and the car insurance, Alex, were all still too darn high.
Except if it's butter or baked goods or cereal. Then you're good.
That's a pretty good diet, actually.
I mean, it's not, I mean,
I could live off that.
That's not the worst thing in the world, but everything else, forget it. So this is a chart that I have questions about that I don't know if it actually means anything, but I'm curious as to the answer. So the white line is the Bloomberg U.S. Financials Conditions Index. So the higher it goes, the looser financial conditions are. The lower it goes, the tighter that they are. The blue line is CPI on a year-over-year basis. Core, I should say, CPI on a year-over-year basis. And what I'm wondering is the loosening in financial conditions that we've seen in part responsible for the uptick in CPI? Basically, when Jay Powell pivoted in December, did that reignite financial conditions and reheat the economy? And I don't know if this chart tells me the answer. So you have the Bloomberg Financial Conditions Index got a lot tighter to June as you saw inflation really pick up. Then when you had sort of a relative bottom in the financial conditions index, you saw a steady climb higher as you saw inflation actually hit its bottom. But now we're moving higher again. So is Jay Powell to blame or not? And in which case, do we need to hear different rhetoric to really tighten those financial conditions to then tighten CPI? Romaine?
Well, our Bloomberg International Economics and Policy Editor, Michael McKee, has had a front row seat to everything going on down in Washington today with that CPI report, with those FOMC minutes. And Mike, we start with that CPI report. It surprised a lot of folks and, of course, really might have changed the dynamics of what the Fed is going to have to talk about at the next couple of meetings.
Well, we have heard Fed officials start to talk about the possibility of fewer than 3 rate cuts this year, and certainly the CPI steps in to tell the markets to trade differently. We got numbers that were higher than anticipated, not by very much, round to 3 places, and it was only a couple of basis points, but just enough to scare the pants off of investors. And you can see why here. The Fed stopped raising rates in July of 2023, and basically the CPI has gone nowhere. It's stuck in a range. It doesn't seem to be going down. Fed policy doesn't seem to be having much of an effect. Now, the minutes we just got basically reflect that. That was 3 weeks ago, and officials at the time said that they had uncertainty about the persistence of inflation and expressed the view that recent data had not increased their confidence. And boy, CPI would not have increased it today. So you have this rate cut pessimism where you've got members of the investing community now pushing out the first rate cut to either September or November. It's gone back and forth, but by the end of the year, maybe two, basically between 1 and 2 rate cuts by the end of the year instead of 3.
At the same time, which was a head scratcher in the minutes, we saw the Fed favors reducing its monthly asset runoff pace by roughly half. That seems like backing away from QT.
Well, they've been planning on backing away from QT, and the reason is they're worried about what happened in 2019 when the Fed let the runoff go too far, and we saw a big backup in rates in the money markets, and that helped paralyze the markets for a bit, and the Fed had to react then. So they've been planning this runoff, and now they got a staff briefing today on their options for it, and basically they generally favored reducing the $60 billion a month Treasury cap by half to about $30 billion, but they don't see any need to trim the $35 billion mortgage market holdings because there aren't enough prepayments. They don't even hit that cap, and they do think that it should happen fairly soon, which raises the question, do we get a balance sheet taper before we get a rate cut?
Whew, that would be a head scratcher. What do you do as an investor in that situation? All right, Mike, thanks a lot. Really appreciate it. So earlier today, former Treasury Secretary Larry Summers reacted to that inflation data, telling Bloomberg's David Weston that investors should seriously consider that the next Fed move is a hike.
A rate cut in June, it seems to me, would be a dangerous and egregious error comparable to the errors the Fed was making in the summer of 2021 when it just didn't get the thread on inflation.
Joining us is Julia Coronado, president and founder of Macropolicy Perspectives. Julia, could the next move be a hike, or do we need to start talking about that?
So I am not going to endorse that the typical summer's bombasticity, shall we say. I think it's sensible to push back expectations for when the Fed might cut rates. But I don't think what we see in this report is a reacceleration so much as just some stickiness. And that's been kind of the debate. Would the last leg of inflation be the hardest or disinflation be the hardest?
Okay.
You know, optimistically, we were thinking no, but maybe it is going to be a little bit stickier. And that's exactly where we saw it is in services inflation, just proving to be a little bit more lingering.
So, okay, Julia, I mean, fair enough. We don't want to go to the hike scenario. But if we just look at the reality that the economy is stronger and inflation is stickier, or at least disinflation is harder to come by, why would we cut at all?
Well, that, again, will be determined by the data. I mean, the question is, you kind of noted, Alex, that we're in this reflexive environment, this sort of ping pong where part of the improved sentiment amongst CFOs and business managers and in the market was based on the expectation that we were done with rate hikes and we were moving to cuts as the year progressed. If that fades away, then so will that optimism. Those financial conditions will tighten up like we're seeing today, and that will slow the economy down. So as we near that kind of post-pandemic equilibrium economy, there's a little bit of moving back and forth in terms of these financial conditions and Fed policy, and where do we find the right amount of restriction to get all the way to 2%?
I mean, every time we have these debates, Julia, when we get a CPI report, any sort of inflation report, we always have to kind of separate what those headline numbers are telling us and sort of what was actually driving those numbers.
Mm-hmm.
When you look at this month's report, particularly compared to some of the reports we got heading out of last year here, was there something materially different in what was driving inflation this time around than last?
Well, so the surprise of inflation for us was very much concentrated in car insurance was a big source of surprise. That is an area that has proven sticky. Car insurance prices are up more than 20% over the year and haven't really slowed down and actually accelerated in March. And that was a surprise. We weren't expecting much moderation very soon, but it actually kind of doubled the pace. So that probably won't continue at that rate, but again, that looks to be a source of ongoing stickiness. Other surprises, apparel prices, those ping pong from one month to the next, so not too much signal there. And by and large, again, we're not like completely derailed from our moderating trajectory here. It's just a little bit less progress than we had expected to see at this in this reading. So I think the overarching story is still on track. It's just may take some more time.
There was concern, though, that when you saw the numbers, particularly around some of the services industries, healthcare, and obviously car insurance and things like that move up, that seemed to rattle people, I think, a little bit more than what you saw on the good side. As you point out, some of those numbers for food and for apparel tend to ebb and flow. But to see that resurgence in some of those services numbers, I think that kind of rattled people, did it not?
Yeah, absolutely. It's the Fed's super core metric certainly jumped, car insurance being a key driver there. And there's some, again, some lags in the CPI. We see market prices of new cars moving down, rising use of incentives to get car sales going. That hasn't yet been captured in either car leasing or new car prices. That was something we were watching, didn't show up in March. Actually, car leasing prices jumped, which is a little at odds with what we're seeing on the ground. So that could be measurement. It could just be lags. We'll find out. I'm not worried about car prices surging with these interest rates and given how far they've already risen.
Yeah, it'll be interesting to see how it all balances out. Julia, gonna have to leave it there. Julia Coronado, president and founder of Macropolicy Perspectives, kicking us off to the close here. Coming up, a conversation with the CEO of Edward Jones, Penny Pennington. We're going to get her take on today's CPI print and, of course, the long-term perspective on what clients are talking about.
Plus, back in business, you got shares of Delta jumping after the airline reports a step up in corporate travel. We're going to get more on the optimism. And one cut you may not be expecting, why those beloved premium credit card rewards may actually be a thing of the past. A conversation coming up next. All that and more right here on The Close. This is Bloomberg.
Inflation is just becoming a very stubborn situation for the Fed.
This is too much for the Fed.
Inflation's not doing what they wanted on average, and this is a problem for them.
The sound that you heard there was the door slamming on a June rate cut. That's gone.
I do think it shuts the door on a June rate cut.
The Fed is not, in our opinion, is not going to be making any moves anytime soon.
They're more likely to hold status quo.
Pretty good reason for them to remain on hold here, see how things go.
A rate cut in June, it seems to me, would be a dangerous and egregious error.
At the moment, I think they'd probably set up for September and December, 2 rate cuts this year.
There's a real risk of no rate cuts. That's starting to come into the narrative, and I think that's new.
They're, creating a problem for themselves in terms of the promises of rate cuts, the inability to actually execute on them.
Those were some Bloomberg TV guests reacting to today's CPI print and whether or not it delays the Federal Reserve's path to cutting rates. Well, here on set to give her many cents is Penny Pennington, CEO and managing partner at Edward Jones. Penny, wonderful to chat with you. Thanks for being here.
It's a pleasure.
It's a great day because I feel like we're really finally recalibrating a higher for longer environment. I think we're looking at 1.5 cuts now, just based on expectations now in the market. How does that make an investor rethink portfolio allocation?
Well, you're right to ask me because I represent 8 million clients across North America, 19,000 financial advisors, $2 trillion of their assets that we are privileged to care for. 500,000 times a week, our financial advisors are meeting with their clients. And I asked a couple of our financial advisors this morning when we got the CPI print, what are your clients going to say when they come in? What are you saying to them? One of my financial advisors said they're not asking about CPI, but we've been talking for a couple of years about their purchasing power. Their purchasing power day to day, their purchasing power for the long term. Day to day, Julia was just talking about car insurance rates have stayed high, gasoline, food. It's a truism that what you bought at the grocery store 3 years ago now for $100 now costs $130. We are scenario planning with our clients for what higher interest rates and higher prices will mean for them, for all of their goals, for the retirement planning, for the shorter term spending that they want to do. We are seeing clients continue to spend retirement dollars for experiences. And this is one of the things I think that may be keeping service inflation where it is. An earlier report talked about summer travel is going to be very high. People are still spending money, and our retired investors are doing that.
I wonder if also part of the reason is that they can park their money in a 2-year bond now, and then they get almost 5% yield, or just put it in a money market fund and get 5 or 6%. Like, are people actually doing that? They're parking their money and they're just taking the yield and going to do something with it?
Sure, you're getting rewarded for shorter term money today where you weren't 5 years ago. So that feels good. The risk in that is parking money at 4 to 5% when inflation is at 3.5% doesn't give you the long-term return that's going to help you meet your goals. So we always stress with our clients the proper allocation of their assets, cash, fixed income, equities, allocated appropriately for your risk tolerance, your time horizon, and the kind of goals, short, medium, and long term, that you're trying to achieve.
How does the higher interest rate environment and the idea that most people believe higher interest rates, at least relatively speaking, are kind of here to stay, how does that change the long-term planning?
Well, there's some puts and takes to that, right? So we're getting rewarded for the shorter term money. But if you're a parent or a grandparent who's thinking about, or a 30-something, thinking about buying a house, that's a different thing, right? So it depends on your goals. It depends on what stage of life you're in as to how you're going to see that higher for longer interest rate environment.
I am curious about some of the longer term trends that we've seen in investing with the individual investors. This sort of gravitation to private markets, the idea that at least on a risk reward balance that there's something maybe there a little bit more attractive than what you're finding in public markets. And we've already seen a lot of high net worth individuals really diversify into that private space. Are you seeing that trend sort of move down the line, the income spectrum?
Well, you're focusing on diversification, which I love, and you're focusing on the fact that a certain kind of democratization of assets and the ways to purchase asset occurs in our capital market system. That can be really healthy. So the traditional asset allocation of cash, fixed income, and public market equities still very sound and strong. But I read a statistic the other day, 92% of companies with $100 million of revenues or more are private. And so it's important that we continue to have a strong and thriving capital market system for capital creation. It is likely also to be important sooner rather than later that access to private assets become more democratized. What is going to be important, though, is clients understanding that client experience is a little bit different than buying a public equity or an ETF or a bond on the bond market. But I do see that coming probably sooner rather than later.
Do we know what percentage will be in those private markets? Like, part of me is also like, yeah, go in the private markets and then just pretend you're not going to get that money back because you don't know what it's going to do. We don't have any test cases really on this. How much would you recommend?
It depends on one's risk tolerance. When you think about liquidity as well, private markets are less liquid assets. When you think about that experience of how quickly do you need to draw your money out and how long-term are your goals, the private markets, less liquid and longer term in their exit, longer term in nature in the exit. So clients are just going to have to be very thoughtful about that, which means our financial advisors are going to be very thoughtful about that in advising them.
What do you think about Bitcoin and crypto?
Well, is crypto proven yet? No, it's not. And when we as a company advise clients based on the fundamentals of assets, based on their cash flows, their revenues, their ability to be sustainable, it's really hard to analyze cryptocurrency right now in that light. We are taking a bit of a wait and see approach at this point. Our clients are not purchasing crypto through us, but we are actively monitoring that situation.
I want to talk about the generational differences, if you will. I mean, are there generational differences? We keep talking about the idea of the boomers sort of aging out and this great wealth transfer, and then you have this younger generation of millennials and Gen Xers, which they always forget about us, and of course Gen Z, who have different priorities and are going to be coming into this investment landscape from a much different starting point than what the boomers did.
You're exactly right. When I think about, I'm a baby boomer. I'm the last year of the baby boomers, so I can channel that, but I can also channel my 30-year-olds. So the boomers and the silent generation are about to think about, they're in motion right now, moving their assets to the next 2 generations. Baby boomers and silent generation thinking about their long lives, remaining healthy in their long lives and having a great quality of life, while at the same time moving their assets to the next 2 generations. Very interestingly, we just did some research, and only about 30% of families are planning on having this conversation with the next 2 generations. That sets those families up for some real anxiety, and we found that out in our research, and perhaps some disharmony after mom and dad or grandma and granddad are gone. And so we would advise to, with your financial advisor, take the emotion out of this family conversation, but begin the process of talking about moving your legacy and your values. You don't have to talk about the dollar signs. This is what makes people uncomfortable sometimes. But talk about the legacy and the values that you want to pass on to the next generation. And then one final thing we found out, 68% of those who own the assets today would like to move them to the next 2 generations during their lifetimes. So a financial advisor helping a family scenario plan for a long life, making sure they don't run out of money, but the beauty, the joy of seeing your children and your grandchildren enjoy some of those assets during your lifetime is pretty special.
Yeah, and hopefully do it in a tax-advantaged way.
Precisely. I'm about to have my first grandchild. My daughter is having her first child, so this is very real for me.
Oh, congratulations.
Thank you.
All right, Penny, it's been wonderful to have you. Penny Pennington, CEO over at Edward Jones. Stick with us. We'll be back in a moment. This is Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start with Deckers Outdoor, the maker of Uggs, Teva, Hoka, downgraded to hold from buy over at Truist, citing a slowdown in direct-to-consumer growth in recent months. The analyst particularly anxious about trends for the Hoka sneaker line. He actually says he's bullish on the brand, but when you look at Google searches for Hoka, that's been steadily decelerating. Shares decelerating today, down 7%. Next up, let's take a look at Arch Resources, a coal miner hit with the downgrade to market perform over at BMO, with the analysts seeing logistical setbacks from that Baltimore port shutdown, coupled with a decline in that high volatile coal prices, creating a negative risk profile for the company. The share is only down fractionally on the day. And let's end on Tesla. Piper Sandler cutting its price target down to 205 from 225. Piper saying it's going to keep that buy rating, but says it's our lowest conviction overweight rated stock out there. The analyst says there's no quick and easy fix right now for what ails Tesla. Those shares are moving lower by 3% on the day. And those are some of our top calls. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Alex Steele. We definitely have a sell-off underway. I'm just checking to see if we're around the lows of the session here. And we're off the lows, but still, I mean, it's really not a great day, down by a full 1 percentage point after we got those hot CPI numbers.
Yeah, I mean, we're still down 3% on the Russell 2000, and we're all off the lows of the day. But you think about the idea of just expectations, right? I mean, this is really what this report was about. It isn't just about hot inflation. It's about a market that for the last 4 or 5 months has been repositioning around rate cuts and repositioning around that disinflation story.
Right. And we kind of knew that maybe this was a possibility, though, right? Like 2 months of hot CPI, and some reason this was going to be a different month. And then it wasn't. Yeah. And then you have this very violent reaction, particularly in the bond market. Now, if you're reporting today, it's a tough tape to have to report into. And that brings us to Delta. So shares of Delta are off by over 2% now, even though the carrier's outlook exceeded expectations. They're anticipating benefits from a step up in corporate travel and a steady leisure demand heading into the summer. We just talked to Penny Pennington, who's like, yeah, retirees, they're taking money out in order to spend and go places. Well, Shelia Kahyaoglu is U.S. equity research analyst over at Jefferies, and she joins us now. What was your take on Delta?
They had a good print. They beat estimates by 9 cents. It was much better than we expected. They had great operational performance that led to better cost performance. And then, interestingly enough, they're reporting on the day of the CPI. domestic pricing was up 3%. That's what's really like penalized this airline industry in 2023. Too much capacity came into the market. Pricing was terrible. Domestic pricing was flat. And we had a huge inflection in domestic pricing in the first quarter. And obviously, you're not getting credit for it
Does
today.
that pricing hold, though, for the rest
Well, they're
of the
saying for Q2, it's flat. And for their guidance for the year, the second half has easier comps. So it's a really good setup for Delta going into the second half of the year with the accelerating corporate and Atlantic doing better than they expected.
So you have a buy rating on the stock, price target at 58. So is there a catalyst that gets us there, or is it just like no bad news?
I think a lot in airlines, honestly. Airlines is the anti-Boeing. I know we'll probably talk about Boeing, but airlines is the anti-Boeing. And it's like if you want to pair with like a HEICO and GE, which are high multiple, which is why investors don't like it, you buy Delta trading at 5 times earnings. I mean, that's super cheap because people don't believe that Delta is going to be able to maintain its premium offering. So margins are going to be 15% operating margins in Q2. That's pretty good for a company that trades at that multiple. So if those continue premium, which they don't add domestic capacity that's mainline anymore.
What do their costs look like right now for Delta, both on the fuel side as well as labor?
So obviously fuel is up a lot, so it's probably hard for them to raise their guidance. But even with that, costs outside of fuel are doing well. They're up only low single digits, and that's pretty amazing considering headcount, maintenance expense, what we're seeing with airline delivery delays. And I like particularly Delta or American, given unlike United and Southwest, they're not expecting new planes this year, so they didn't pre-hire those pilots, so they're not carrying that extra cost.
I'm curious about the plane deliveries here. I've flown a lot lately, and I've actually been kind of astonished at how old some of the planes I've been on. Now, maybe I was just on the wrong routes, but does that matter for consumers? I mean, does that feed in at all to demand, and more importantly, what people are willing to pay, or is that not a concern?
You could call me the next time you're flying, by the way, because I'm pretty formulaic about what I fly where. And I was actually in Chicago this week, and I flew Delta because even though it's a United hub, but they got me there on time. They even got me there early, and people really distinguish themselves when they fly Delta. They pay for that premium ticket to know they're going to get wherever they are on time, despite the plane being older. And that's really what led to Delta's beat was the operational.
It had like one of those little tiny little movie screens on the back. I couldn't even watch it. I mean, the struggle is real, Sheila.
I expect that now. When I don't get the little screen, I'm like, what is up? What is going on? Well, talking about planes, let's go to Boeing.
Sure.
You have a buy rating on the stock. You have a $300 price target on there. Whew. The news just keeps getting worse and worse. Like when do we reach like the trough for bad news?
I feel like the stock is just going to settle out here for a few months until we get the new CEO. When we look at Q1, it's not going to be good, obviously. $4 billion of cash outflow. We have $2 billion of cash outflow in Q2. That means to meet consensus estimates, you have to generate $7 billion in the second half. Clearly, that's not happening. So consensus has to come down. We're below that. The CEO search, we think, is just starting. But whoever comes in could totally, obviously, is going to throw $10 billion out the window, which is Boeing's financial target, and potentially do a restructuring of the portfolio and of the operation. So it's going to take some time, but we still see significant upside in this global duopoly.
Well, speaking of CEO searches, one of Boeing's suppliers got a new CEO, and then I think got another new CEO, Hexcel, and those shares are down 13% on the back of that.
So I think investors are assuming the CEO of Spirit, who left in October, is now CEO of Hexcel, announced last night, is going to destroy $1 billion of value at Hexcel. We have a hold rating on Hexcel for a multitude of reasons. We don't prefer that supplier. The supplier we like is GE and Howmet for their pricing power. We don't think Hexcel has that. So investors are not liking this move, just given the history at Spirit. But Spirit's a very different company than Hexcel. Spirit was, kind of stuck into their position given the agreements they had with Boeing, and there was no way out.
We only got about 30 seconds here, but how giddy are you over GE right now? I mean, they just seem to be doing everything right. I mean, I remember a few years ago, it was like everybody. This was like dead.
The herd.
But I mean, the turnaround's been phenomenal, and particularly with the aviation business.
And just spun off on April 2nd, so you have a clean slate. And I think the longer these delivery delays happen, the better it is for their mix. And 70% of their revenues come from services. Longer older planes fly, the more it benefits GE.
All right, Sheila, always great to have you. And you've got to give us some tips on how to better book a plane so I can get on one of those newfangled, wide-body Airbuses or something. Shelia Kahyaoglu over at Jefferies. A closer look today at those results out of Delta. Of course, next week we do get United Airlines and I think a couple others as well. All right, coming up here, we're going to talk about an uptrend that we've been seeing in lithium prices and how at least one analyst says, well, that might actually be at an end. That's coming up in our Stock of the Hour, a closer look at Albemarle. This is The Close on Bloomberg. All right, we're taking a closer look at lithium prices right now because they may actually be approaching a bottom. That's according to analysts over at Bank of America, and that could be good news for Albemarle. The firm upgrading the mining giant to buy from hold and increasing its price target to 156 from 137. The analyst behind that call, Steve Byrne, joining us right now, talk a little bit more about it. And Steve, everyone has been so focused on that big jump that we saw in prices and, of course, that big drop that we've seen in prices. You seem to think that that's over and we're now headed for an uptrend?
I do. I think we are headed for an upturn. At least I think we're past the bottom. I don't know that we're going to go back to that peak. That was an incredible situation. It was only 15 months ago. But I do think that we're past the bottom. I think there's a fairly bearish sentiment out there on lithium right now based on the conversation in this country on EVs. But the demand driver is Asia, and I think supply and demand looks pretty favorable to me right now.
Well, tell me how the EV picture folds into this, because we've been talking a lot about this slowdown that we've been seeing in EV sales, at least here in North America. I know it's a little bit of a different story overseas in China. Kind of square that circle for us.
Well, you have probably 70% of EVs are produced in Asia. That's where the demand is coming from. And the demand growth there, the shipments of EVs there are still in the 20%, growth per year. I mean, that's in a level of demand growth that's unlike any other chemical that I've ever worked with, and I've been covering chemicals a long time. 20% demand growth is in a different category, and that's a demand driver that could cause a squeeze pretty quickly, just like what caused it in 2022. We're past the bottom. Supply and demand looks more favorable, and you have the demand growth in Asia. That is the primary driver, 70%.
Yeah. Hey, Steve, how quickly can that turn, though? Because I remember a few years ago, I was talking about the scarcity in lithium. There's not that many places to get lithium. There's not that many companies that then do it. But on the flip side, when you ramp it up, prices tank, and then therefore it becomes a cyclical commodity. How quickly does it turn?
Well, I guess one risk to my upgrade would be that there hasn't been much of a slowdown in operating rates. It is a commodity. We had an oversupply. That oversupply has now pretty much been normalized. And when you have demand growth at 20%, I think that could increase pretty quickly. But I'm a little surprised that the producers in the world haven't slowed operating rates that much. And so the risk to my call is that this takes, several quarters to start to get some momentum. Mm-hmm. But I do think that we're past the bottom.
What is the beta or the relationship between, say, a stock like Albemarle and lithium prices? Is it 1-for-1? Does it have a higher rate?
Oh, I would say it's much higher than that, just given, this is more or less a pure play in lithium. They're the biggest lithium producer in the world. And, it's a commodity and pricing can go up pretty sharply. And so I think there could be, an equity response that's kind of disproportionate than what might look like a modest improvement in pricing. So it's intriguing to me at this point.
I am curious, as part of this call, Steve, you also kind of took a little bit of a softer approach when it came to CF Industries, downgrading that stock. What's the disparity there?
Well, that's another commodity, and also an extremely volatile commodity. Nitrogen fertilizer is produced every day of the year, but it's consumed in only a few months of the year. I mean, farmers only apply it before they plant, and that's a situation where we're, here we are in the middle of April in North America, and the Northern Hemisphere is pretty similar. We're pretty much, getting into the peak of consumption, and pricing is already starting to fall. So this is really more of a short-term trade in my view. what I like about CF is really the longer term opportunity in clean ammonia. I don't know if you're familiar with clean ammonia, but it's no CO2 emissions. Ammonia is a very reasonable fuel. There's no carbon in ammonia, and it could be shipped around the world easily. It's a liquid. It's a pretty interesting opportunity for CF. So it's really more of a near-term trade on their commodity, but with a longer-term upside.
Hey, Steve, thanks a lot. We really appreciate it. Steve Byrne, biotech analyst over at Bank of America Securities. And that, I think, lies the interesting point about CF Industries is that you have these huge secular shifts that are happening, right? Green transition, EVs, lithium, nitrogen fertilizer, yada, yada, ammonium. But in the medium term, there's still very heavy cyclical indicators that happen that can be very whippy for some of these companies, and how you manage that, even as a shareholder.
Yep, absolutely.
Cool. Okay. Coming up, we're going to count you down to the closing bells with Angela Mwanza, Managing Director over at the Rockefeller Global Family Office. We're taking a look at these markets, not on the lows of the session, but it definitely isn't great. You're looking at S&P off by about 1 percentage point, and you're also looking at the sell-off in the bond market continuing with the front-end yields really popping higher, up by about 22 basis points. We're going to take you through all the moves. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostic alongside Alex Steele. Just about 10 minutes until we get to those closing bells. And we want to bring you up to date here on some news crossing the terminal right now on Apple. We talked a lot in 2023 about all of the unionization efforts there at Starbucks and a few other places. Those unionization efforts appear to have died down. We're now learning, though, they are bubbling back up to the surface. Mark Gurman reporting that an Apple store in suburban New Jersey, right outside of New York here, has petitioned to unionize. This is about 104 employees there at that store, the staff being represented by the Communication Workers of America. And Alex, we spent a lot of time last year talking about all of the power that labor had, or at least that they thought they had over the last couple of years, and using that to sort of argue for wages and things. And of course, that was a big driver of a lot of the inflationary pressures. We thought that had died down, but maybe it's back.
Yeah, we're looking at the stock still down by about 0.8%. This marks the 5th U.S. Apple store, I should point out, where workers have petitioned to unionize, now joining locations in Oklahoma City, Maryland, in Atlanta, as well as St. Louis. All right, joining us now on the phone is Mark Gurman. He broke the scoop. He breaks all the Apple scoops. He is deep inside the Apple psychology. Walk us through sort of the importance of this for investors when it comes to Apple.
Yeah, thank you so much for having me. If Apple retail stores continue to unionize and you see a majority of stores unionize, you can see pricing pressure there, as Apple would have to probably hike pay and some benefits and such. Maybe there becomes a point where they open fewer retail stores, where they begin to close retail stores. Unions is just simply something that Apple does not want to deal with. They're a very controlling company in every facet, from product development to how they manage the rollout of products to how they manage their employees and customers and customer service and such. So this is absolutely just, picking a fight within, the way Apple typically likes to operate. So they're not thrilled about it. This has died down over the last year or so. Like you both said, it felt like you weren't hearing anything about new stores unionizing. To date, there are 5 retail stores in the U.S. that we know about that have petitioned to unionize. Of the 5, only the stores in Oklahoma City and the one in Towson, Maryland, have successfully unionized. Mm-hmm. Now, the thing you should note there is that those stores, despite being unionized, they haven't gotten any special privileges or special pay or reached any real collective bargaining agreements with Apple. So it's still nascent. Apple hasn't really moved an inch there. We'll see what happens as NLRB complaints and different lawsuits continue to emerge on the topic.
All right, Mark, thanks a lot. Super appreciate it. Bloomberg's Mark Gurman joining us there. And just broadly checking on the market, Apple's down by about 0.9%. Overall market is also down. S&P Energy Index is the only part of the S&P that's in positive territory due to the spike in oil prices. Bonds continue to climb higher. And the Russell, I should point out, below its 50-day moving average. So watch that as well, Romaine.
We only got 7 minutes to the close, so let's get right to it. Angela Mwanza joining us right now, private advisor and managing director over at the Rockefeller Global Family Office. And Angela, mean, this was a day where a lot of us were talking about that CPI report and inflation. I think the report out of Mark Gurman there on Apple, a reminder there are still a lot of price pressures out there here. What did you make of today's report?
Absolutely, Romain. Great to see you. I mean, that CPI print was much hotter than expected. Markets responded as we would expect. A lot of red on the tape. If I'm Federal Reserve Chair Jay Powell, I'm doing a whole big oh shucks, because no chance of cutting rates in June would be my assessment. It would be very difficult for him to get consensus to move. It seems more likely that we're looking at a September cut, and now it may be one, maybe two, maybe none at all. How that impacts our outlook for the markets is kind of marginal. Ultimately, we see above trend growth for the markets going forward despite this print. And I think we've got very good reason to believe that. We've got a broadening of returns across multiple industries beyond the Magnificent Seven, and a rotation, seeing more cyclicals taking over on the return spectrum versus defensives. We've had great economic data. Manufacturing has come in very positively, as well as the employment data that we saw last week. And lastly, earnings season. I think projections so far are looking pretty positive, almost I think close to 11% expectations on earnings year-over-year growth. And so with that backdrop, I think we have very good reason to be positive on the markets.
Are you comfortable with those expectations? I mean, all the talk with that CPI report was the idea, it wasn't just that inflation was hot, it was just that the market had much different expectations than I guess what we're getting out of those numbers. As earnings season kicks off today and of course on Friday with the big banks here, do you think investors are positioned in a way that's realistic with what you are anticipating?
Well, Romain, I think a lot of our investors have been sitting in cash, because if you've been getting 5.5% on your cash, that's been very opportunistic, and I have the liquidity and the option to jump in where I see dips. So looking at the market where we are today, we're coming from a place of much less volatility, which is kind of interesting given all of the news that we've been receiving. I expect more volatility as the year goes on, which means there's more opportunity to buy on those dips. We've got elections coming. There's a lot more uncertainty around that. And we've had a ton of liquidity pumped into the system. Our chief investment officer likes to talk about the sugar high of all of this liquidity. That's going to go away going into next year, and we'll have a different administration. We have a budget deficit to deal with. So there are some headwinds that might be a little bit of a challenge, but ultimately the economic data does not lie, and you don't fight the Fed, and the data is telling us that things are looking pretty good. We are resilient to withstand a higher interest rate for longer type of environment.
Does that mean that the broadening out of the rally that we started to see, do you feel like that can continue, or does that part of the narrative take a dent?
When you look at the valuations, there's a temptation to say, "Oh my gosh, it's already run up. I've missed the party, big time FOMO." However, I think if looking at the transformation that AI is bringing to the table, there is a lot more room to move upwards. So we're still constructive on those opportunities. We're just saying that there's been a huge run up. There's an opportunity to do some rebalancing. And yes, there's other areas to invest beyond the Magnificent Seven that are the infrastructure around AI. If you think about all of the data centers, the cooling, all of the systems, the chips that are going to be required for the growth in AI that we are anticipating, that we're hoping for, that we're investing in, that's where I see a lot of great opportunity.
All right, Angela, going to have to leave it there. Always great to catch up with you, and we will talk again soon. Angela Mwanza, Managing Director and Private Advisor at the Rockefeller Global Family Office. All right, Alex Steele, it could have been worse.
It could have been worse.
In the markets. I mean, we're well off the lows of the day. I mean, still a pretty significant sell-off, and of course, an even worse sell-off in the bond market now as everyone re-rates around that CPI report.
I'm just really interested in all the technical levels, like where we closed today and then any follow-through buying. Like, it wouldn't surprise me if we came in tomorrow and futures were higher, but then the destruction we saw, say, in the Russell below that 50-day, I don't know, maybe we see some follow-through.
I think for the large caps, when you put up an intraday chart of the S&P, you really saw some of that dip buying, even shortly after the open. So it'll be interesting to see what happens tomorrow as we break down all the price action that happened today. Stick with us as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. Here to help take us beyond the bell, it's a global simulcast. Scarlet Fu joining us in Studio 2. Carol Masser and Tim Stenovic bringing up the rear. Welcome to our audiences across all of our Bloomberg platforms. You know, we've had a lot of mad days, Carol, over the last few days and weeks, but today really broke that streak.
Yeah, absolutely. Really interesting day, right? And I feel like, of course, it all kicked off this morning with the inflation print that did come in hotter than forecast. And then, of course, you got the Fed minutes. But it's interesting to see kind of the movement we've seen kind of bouncing around on the equity side of things. But if you look at the Treasury curve, very clear message about higher for longer and higher rates, everybody.
Yeah, it's pretty remarkable to see that, you know, just back in December, folks were talking about potentially 6 rate cuts this year. Now, Scarlett, I think many will be surprised if we see 3 rate cuts this year. 2 is potentially what's going to happen. You have folks like Torsten Slok coming out with a note this morning saying we're sticking to our view that the Fed will not cut rates in 2024.
And there are some people who also... There are also some people who say that maybe the Fed needs to consider talking about raising rates, maybe not out loud, but that also kind of is always a prospect. It really sets up the day in an interesting way for tomorrow's wholesale inflation number as well. Is that going to move the needle?
I don't know. I mean, I would say maybe, but then economists always say you don't know. PPI never moves the needle. But I just want to just to your rate cut point there, Scarlett, because, I mean, you go through WIRP and you look at what the swaps market is pricing in. We're now basically priced in for 2 rate cuts this year. That's what the market is expecting. But more importantly, you don't have any real consensus as to when that really kicks off. I mean, everyone's now looking to September, but that's not even a slam dunk.
Does it really matter when, or does it matter how many? No one's taking out a cut for the whole cutting cycle. It's just a matter of pushing it back.
I think it matters because, I mean, you get to this, I mean, if you believe this idea that the Fed doesn't want to get in the way of an election cycle, and if they're not going to start until September, then how much wiggle room does that give them? Do they just do a 50 in September and start, or do they just be brave enough and just say, we're just ignoring the election, we're going to do whatever we need?
Hey, the market's closed.
The market is closed here, Carol Masser, and so let's walk through the numbers.
We were really engaged in that conversation.
The Dow Jones Industrial Average is going to close down on the day, off the lows of the day, but still down 1%, 422 points lower than where it was yesterday. The S&P 500 down 49 points, or about 1%. The NASDAQ Composite down about 0.8%. But the biggest decliners out there were in your cyclical space. Dow Transport's down 2%. S&P 400 Midcaps down 2%, and the Russell 2000 closing out the day down 2.5.
All right, we're going to get to the sector performance in just a moment, but just again, staying kind of macro on the S&P 500. Big picture, 431 names in the index, Scarlett, to the downside, 72 to the upside.
Yeah, and looking at the IMAP, lots and lots of red. You have 11 sectors, only 1 finished in the green, and that's barely. Energy up by 0.3%, thanks to rising oil prices. WTI surpassing $86 a barrel. In terms of the leading underperformers, real estate investment trust losing more than 4%. Utilities, another interest rate sensitive group, down 1.75%, and materials off by 1.5%.
All right, guys, let me get to some of the individual gainers. Number 1 gainer in the NASDAQ 100 was NVIDIA, also a top performer in the S&P 500. NVIDIA, this is coming from Morgan Stanley, saying it's the best way to get exposure to artificial intelligence as visibility into strong spending continues to build. Again, Morgan Stanley saying this in a note. They reiterated their overweight rating on NVIDIA while raising its price target to $1,000 a share from $795 a share. NVIDIA finishing the day just shy of a 2% gain, closing at $870 and change. All right, let's go to GE, if we may. That stock up about 1.4% in today's session. This, again, was a top performer in the S&P 500, at least earlier in the day. Company we know created following the spinoff last week of GE and the spinoff of GE Vernova, which is the renewables business. So GE, again, up 1.4%. Didn't really find any specific news, but yesterday, GE Aerospace, which is now the GE ticker, upgraded to buy from holdover at Cowen, highlighting the company's position as a market leader in commercial jet engine technology and its extended aftermarket visibility. They raised the price target to $180 from $175. The stock, by the way, ticker GE, is up about 54% so far this year. And while on the subject of GE, or formerly, or, you know, it's now kind of all its new iterations, if you will, GE Vernova, ticker GEV, that stock was up about 4.7%, a top gainer, I think the number 1 gainer in the S&P 500. Again, no real news on it, but just interesting to see once again that in a market where there was some stress maybe today and risk off, that's where we saw investors putting some effort.
All right, well, let's talk about some of the notable decliners. In the S&P 500, among the worst performers were major U.S. tech and internet stocks. We saw shares of Apple fall 1.1%, Tesla down 2.9% today. Shares of Microsoft falling today by 0.7%. This all happening after that latest CPI data came in hotter than expected, suggesting that the Fed is going to delay interest rate cuts until later this year. Do you want to talk about Deckers Outdoor, the worst performer on a percentage basis in the S&P 500? Apparently, people aren't buying those Hokas like they used to. Truist came out. They have the credit card data, and they said that it signals direct-to-consumer growth of the Hoka sneaker brand slowed in the middle of February and remains softer through March. Shares down more than 6% on the day today. Should note that Deckers Outdoor also owns UGG, Teva, Sanuk, and more.
And apparently, UGG demand for UGGs is still pretty solid. So.
They're classic. What can I say?
Yeah, good for those teenage girls.
It's a staple in the closet. I'm just going to say that.
Certainly in the Northeast.
Big in California, too, for those surfers. Delta Airlines, ticker DAL, reported earnings earlier today. And it was interesting because earnings surpassed expectations. The stock moved as high as 4% to the upside in the trade. But then a little later in the day, it started moving lower, ended up closing down by 2.3%. This after the inflation data came out, showed that airfares dropped more than 7% in March from the previous year. It was the biggest increase, or the biggest decrease rather, since November. Separately, we saw oil move higher. Jet fuel, of course, one of the airline industry's biggest expenses.
All right, let's take a look at the bond market, because that's where a lot of the action really emanated from, guys. You had the sell-off, a pretty broad base, but really in the front end in particular, you saw a move of about 22 basis points. That was the biggest move we've seen on the day since the SVB crisis about a year ago. The 10-year yield saw the biggest move, about 18 basis points. We haven't seen that since September of 2022. So lots of really big superlatives, guys, as sort of like the big moves, the chunky moves in the bond market. We're like kissing 5% now on the 2-year SCAR.
Yeah, some mammoth moves in the bond market there. There are still some earnings crossing the wire. Let's talk about Rent the Runway, which, of course, had a reverse stock split just earlier this month. Fourth quarter revenue, or its fiscal fourth quarter revenue, I should say, $75.8 million, slightly higher than what analysts were looking for, which was $74.5 million. Adjusted EBITDA of $11.2 million, almost double what analysts were looking for. As for the outlook for this quarter, Rent the Runway sees $73 to $75 million. That is shy of what analysts were looking for, which was $75.9 million. And revenue growth of between 1% to 6% for fiscal year 2024. They got to convince people to shell out anywhere from $90 to $200 a month to keep those fashion subscriptions going.
Yeah, it's interesting, too. And I'm just looking at the stock in the aftermarket, up about 9.5%. It was down about 30% year to date here. So it's been under a lot of pressure. And you've got about 20% of the float being shorted. So anybody who was maybe counting on it not being so great, maybe doing a little bit of short covering right now.
The company coming out and saying that customers have been buying more inventory, customer retention has markedly improved year over year, and that the premium personal concierge service to style customers made it easier for customers to discover inventory that they love and created more aspirational product experience.
All right, guys, next time you go to order your latte at Starbucks, you're going to have to whisper, because apparently they are creating designs within some of their stores basically to curb noise. They want to make order taking or order giving, if you will, easier, because apparently some of the orders are coming out wrong. And I guess people who are taking the orders and so on and so forth, the baristas, they're not hearing it clearly, and that actually costs them money.
Well, also what's interesting on this one, too, is maybe if their drinks weren't so complicated, it wouldn't be a problem.
Half double decaf with a double mocha twist?
I can never order correctly.
So like if you didn't have to order for 20 minutes, maybe you could hear them better.
Or maybe they should call a small and a medium a medium.
Yeah, totally agree with that.
Is this
100%.
Seinfeld?
Yes.
Is this Seinfeld? Are we watching Seinfeld?
I was surprised to see this given the growth of online and mobile ordering, that people still ordered using their voices. I thought it was all just done over the phone.
I actually find this story fascinating, too. I mean, there was a story just a couple of days ago about how another food chain, Polo Campero, had actually tried to find ways to sort of make its ordering process more efficient.
Yeah, got to decrease those steps,
reducing the amount of steps that folks had to take, people working there had to take, and in theory, you get your order faster. So, look, I guess you experiment with what you can. I haven't been in a Starbucks in a while, but if it was that loud and they couldn't get the order right, then, maybe it works.
Romain sends his team to get his Starbucks. That's how important he is.
I would think they want to keep it loud. I would think they want to keep it loud to prevent people from sort of camping out with their laptops in there. and just like taking up all the seats for the whole day?
They do that anyway. Noise canceling headphones.
Oh yeah, okay.
How do I get a team? How do we get a team?
You got a team.
We are the team.
We do have a great team, actually. We do have a great team. All right, guys, that is a wrap. Our cross-platform coverage on this Wednesday, radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell. We will see you again, same time, same place tomorrow.
And we continue our coverage right here on Bloomberg Television, a deeper dive into the CPI print and a push ahead to what happens next. Seema Shah, Chief Global Strategist at Principal Asset Management. She's up next on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. And Scarlett, we haven't had a whole lot to talk about when it comes to the price action in the market prior to today.
Yeah.
But that changed in a big way, a big drop in all of the major indices on the day. This after that big CPI report this morning. 3 straight reports that we've gotten now that really came in a lot hotter than expectations. The S&P 500 finishing down about 1% on the day, below the 20-day moving average. We should point out that the NASDAQ and the Russell 2000 now below their 50-day moving averages here. So you have a fundamental story as well as a technical one to keep an eye on. And of course, most of the big stocks that moved today were the rate sensitive ones. You saw the REIT index move down about 4% here on the day. And a lot of that, of course, had to do with the big bump up we saw in yields. More than 20 basis points higher on both that 2-year and the 5-year yield. Your 5-year now at 4.6 and your 2-year yield camped out just under 5%. But it wasn't all gloom and doom out there, Scarlett. We did have the majority of stocks moving lower, but there were a few bright spots out there as well.
Yeah, one of them is a Magnificent 7 stock, too, that's done pretty well this year. Meta defined the overall sell-off. Okay, it didn't gain a whole lot, 0.5%, but this after it announced it's making its own chip in-house to power its AI services in order to reduce its reliance on NVIDIA and other outside semiconductor makers. So in doing so, Meta becomes or joins the other big tech companies in bringing chip making in-house, like Amazon Web Services, Google, and Microsoft. I also want to point out Rent the Runway, up 36% on the day. Now, this is a company, the fashion rental company, of course, that has seen some massive moves. It's gained every day this week, and it's up about 45% this week. And this is after it fallen to a record low last week as it did a reverse stock split to avoid delisting on the NASDAQ. We also had a lot of retailers warn that consumer demand was softening. Now, in after-hours trade, the stock is continuing to move up by 41%. This is a highly shorted stock, so there might be a lot of short covering in the meantime. And to that end, you can tell because the stock is down about 30% so far this year. We'll continue to keep an eye on this, but the company did say that its forecast for this quarter trails some analyst estimates. As for our top story this hour, inflation data in an election year. The White House, we know, is hyper aware of voters' concerns about rising inflation for everyday items when President Biden is polling behind Donald Trump in his handling of the economy. So a third straight month of faster than expected price increases does create a political problem, not to mention the fact that hotter inflation pushes out any rate cut to later in the year. And of course, that potentially intrudes with Fed decision making. Romaine?
Yeah, not only is this going to complicate things maybe for the president and the other politicians out there, but it might actually complicate things for investors. It's kind of been interesting to take a look at some of the stock picking hedge funds out there. They actually did gain in the first quarter more than any other major strategy out there, but that still wasn't actually enough to beat the benchmark indexes. Emma Palmer joining us right now, our hedge fund reporter, with a closer look at some of the returns we saw and, well, I guess some of the returns that we didn't. Why are they trailing the benchmarks?
So when we look at some of these equity funds, they did well, generally speaking. But yes, they trailed the benchmark, even if they did better than other hedge fund strategies. You're looking at some of the numbers of these sizable and notable hedge fund firms. They posted returns of 4, 5, 6% when the S&P was up 11, the NASDAQ was up 9. People go to these stock picking funds with the intention that they provide alpha, that they beat the S&P when possible. And so some of these numbers are not ideal.
Okay, so there's always a lot to keep in mind here. In terms of who did post double-digit gains, what exactly did they do? What do we know about what got them there?
Yes, so when we look at Light Street, for example, which is up 35%, or Whale Rock up more than 20%, when you see some of these funds, they did well, but they were invested also, if we look at their ADVs or their 13F filings as of December, in NVIDIA, Meta, Amazon, these names that have rallied, but also names that we know low and have done well. And so what investors also like to see is funds that have made money not just on the big popular tech names, but that are making money on lesser known stocks or uncorrelated to the market. So they're impressed with these numbers, but they would, I'm sure, like to see a bit more diversification.
But this gets to this idea of, following the herd or really trying to, as you say, go out there and find alpha, which often means you're going against the tide here. So what does this all mean? Are we just going to see people now just gravitate back to Microsoft and NVIDIA?
Well, one of the people we quote in our story, there was a report that came out from Man Group, and they are very concerned about crowding. If everyone's in the same stocks, does that not create a risk when it comes to if there's a correction or if there's some concern in the stocks, everyone piling into the same things? And so this gentleman wrote that he has seldom felt as nervous as he feels right now with the risk of crowding. And also it's hard sometimes for investors to tell and to see the crowding. And so sometimes allocators will be in funds and then later on realize, oh, there's a lot of overlap.
All right, a nice read on what we saw in the first quarter. And as we look ahead to what happens in 2Q and beyond, of course, the Fed is going to be a big part of that, as Seema was just talking about. We had a chance to catch up a little bit earlier with JP Morgan Asset Management Chief Global Strategist David Kelly about the Fed's effect on the markets. Take a listen.
They do not have as much impact on the economy day to day as they think. They spent a decade trying to speed the economy up, failed. Now they've been trying to slow the economy down, failed. So what they can do, though, with a lot of this active monetary policy is disrupt financial markets, misprice assets. Last decade, we mispriced housing terribly, and now a large chunk of younger Americans can never buy a house because home prices are just too high when you've got normal mortgage rates. We've mispriced a lot of speculative assets, meme stocks and mega cap stocks of some kinds, and cryptocurrencies. All were, these things were funded because the carrying cost of crazy was zero.
And that was David Kelly speaking on Bloomberg Surveillance this morning. Seema Shah joining us right now on The Close. She's Chief Global Strategist at Principal Asset Management. And Seema, I want to build off what David was getting at here. The idea that I think the expectations we had coming into this year, to a certain extent, have materially changed just over the last 3 months. Does it matter? Is there still sort of, room there for whatever adjustments the markets need to make to this new reality that you're just not going to get 6 rate cuts this year?
You're right. I mean, clearly, beginning of the year, what the market was anticipating was very, very incorrect. I mean, it never really made sense given the strength of the economy. And now I think what the repricing that we've seen is fair. I think we're fairly priced at this stage. Now, for equity markets, the run up this year has been partly based on the idea that you can have a soft landing and you can have rate cuts and it will all work out very nicely. So it's that perfect scenario. And so now that you've had this significant move, even in the last week or so, it does mean it's quite clear to see that equity markets are struggling off the back of this. The question for us now is this equity market pullback, is it going to be sustained, or can we see a return to that rally that we'd had at the beginning of the year? Now, I do think that the first couple of weeks are going to be tough, right? Equity markets still have to digest, investors have to digest this kind of new world of less cuts. But ultimately, I think what investors should return to remembering is that if the Fed is not going to deliver the number of cuts that they were expecting at the beginning of the year, it's because the economy is strong. And if the economy is strong, then earnings are going to be strong. And that has to be the fundamental basis for equity markets. So actually, we do think that the market rally from the beginning of the year is going to be sustained into the second half of the year. Right. Probably not quite at the speed that we've been enjoying. But we still think this is going to be a positive 2024.
But given the run-up that we've had, particularly in, as Seema was getting at, that sort of concentrated part of the market, and there has been this search for diversification, but every time we get an economic report that rattles people or some sort of geopolitical incident, then you see people sort of abandon that cyclical trade, abandon that sort of real economy trade and move right back to where the safety has been for quite some time. Do you see a real break in that cycle?
So we have been expecting there to be a broadening out this year. For example, we have maintained an overweight to large cap, and we have been introducing a slight overweight to the small cap space. And you're right, because that small cap space, for it to perform well for more than just a week or two, it has to be a case of a soft landing combined with rate cuts. So maybe for the next couple of months, at least until you get closer to the eventual date, whenever it is, when the Fed cuts, you're going to have some wobbles within that small cap space. But eventually, when it does come, we do think that the small cap can deliver pretty strong returns, particularly when you take into account the valuations. But I mean, I agree. Look, we are not going to discount. We're not going to push back against the Mag 7's performance. ultimately people are looking for strong balance sheets. They want to have some kind of stability. And where best to go than those Magnificent Seven. So we actually continue to maintain that exposure, not looking to reduce at any point.
Yeah, you work with what's been working, essentially. We had heard from David Kelly earlier talking about how the Fed had mispriced a lot of speculative assets. Are conventional assets, let's just say credit, for instance, mispriced? Are investment grade credit or high yield credit mispriced right now?
No, we don't think so, actually. So when we look at investment grade and high yield credit, look, the spreads are clearly historically tight. But that is based on a strong economy. And fine, the idea that the Fed is pushing back potentially on rate cuts is a concern, but they're pushing back against it because there is a solid economy. So actually, from our perspective, we do think that credits can continue to perform well. Maybe there won't be further spread tightening from here, but equally, we're not expecting some major spread widening. So we do have an overweight to credit, and particularly in the high yield side.
But higher for longer is not good for credit overall, especially those companies that are really struggling. At what point will the lower rated investment grade or lower rated junk credit start to feel the effects of a delayed Fed rate cut?
Yeah, it's a great question because actually that credit maturity wall that we've been facing, been approaching, continues to be a real concern for investors. Now, there's a couple of different scenarios here. For example, for the high yield space, as long as the economy is strong, then most of those issuers can scale that wall fairly easily. The lowest rated issuers, yes, there could be problems. This is when, I guess, some of the reality starts to hit when you've got a continuation of higher rates. But particularly within that credit maturity wall for the high yield as well, most of that is biased to skew towards the higher quality credits within high yield. So we're not anticipating major strains for the credit space. But of course, just like at any point, investors need to be careful about what they're investing in. And I guess we wouldn't be focusing on some of that triple C space. It's more like kind of the single Bs that we'd be looking at within the high yield.
Yeah, makes sense. Avoiding triple C, at least for now. Seema Shah of Principal Asset Management, thank you very much for joining us today. Coming up, we're going to zero in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg.
Season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Jack Ma, sounding noticeably more upbeat about Alibaba in a lengthy memo posted on an internal company forum. As you know, Romain, he's been largely MIA for the last 2 years, aside from speaking up in the internal memo today and back in November.
Yeah, I mean, he's like the ghost who just pops up every few months. But I guess it's an encouraging sign, that it seems to imply that he's still sort of involved in the company. And obviously he has, I guess, a long enough leash to be able to put out these types of memos. But it also seemed to suggest that maybe the worst is behind Alibaba. I mean, all the stuff that they've been dealing with the regulatory crackdown and the economic slowdown, this was a pretty upbeat tone to it.
Yeah, not to mention the reorganization of the company from top to bottom. And he seems to think that the company is now on the right track. So, we'll wait to see in another quarter or so or another half year whether he pops his head up again.
Yeah. Oh, somebody I've been keeping an eye on is quite possibly the last hedge fund manager in New York. Larry Robbins, always quipping that basically everyone he knows has already moved to Florida, and now he's finally setting up shop and deciding to move as well. He's the founder of Glenview Capital Management. But there's a twist on this. He's actually saying he's still going to work in New York. He's not moving the firm, but he is moving his family, and they're going to be down there in Florida. They have a temporary home now while he builds a new home in his designated place. But he said he's still going to commute to New York 3 days a week and he's going to keep his house in New Jersey. So he'll still be coming back and forth, but this is just more evidence of just the exodus we've seen of high-profile fund managers.
So this is not about taxes like it might have been for the other guys.
I don't want to speculate and get myself in trouble. All I can do is just tell you what he said, and that's what he said.
Well, he says it's a move for his family. He's got 3 young kids, so that's part of it, right? This healthier lifestyle. And by the way, none of the firm's 53 employees is being asked to relocate to Florida.
No.
Right?
He's not moving the firm. This is a personal decision on his part.
Okay, got it. All right, the last person I'm watching is Taylor Swift. She is buying carbon
Is she moving
offsets.
to Florida?
She lives on a private jet, and I think that's the issue, right? She's buying carbon offsets to counter the emissions generated by her private jet during her Eras World Tour. The problem is the carbon offset market is a lot less transparent than it appears, and if you don't say which credits you're buying or where you're buying it from, it's really not clear how much you're offsetting.
Can I just say, I don't understand the obsession with her and this jet. I mean, she's rich.
I think people are just obsessed with her.
And she has a job that requires her to be in different cities on a moment's notice. So, of course she's going to have maybe a bigger carbon footprint than the rest of us.
People project themselves onto her because they are obsessed with her.
Okay. Well, I mean, what's she supposed to do? Walk? Bike?
No, then she couldn't perform for her fans, right? All right, coming up, the 2024 Masters kick off tomorrow. We're going to talk about golf. This is The Close on Bloomberg. Drama between the PGA Tour and the upstart Live Golf have kept professional golf in a state of deep uncertainty. With the Masters tournament set to begin tomorrow, this tension is mounting once again. Joining us now for more is Randall Williams. He is U.S. sports business reporter for Bloomberg News. So, Randall, give us the state of play here, because 2 years ago, PGA and Live Golf were tearing each other's eyeballs out. And then last year, they surprised everyone, said, hey, we're going to join forces. But nothing has happened since then.
Yeah, the negotiations blew past their December 31st deadline, and they're still ongoing. Both sides have said they're making progress, but clearly not enough to bring golf back together again.
So, I mean, as we go into the Masters, I mean, this is where all eyes are basically on the PGA, for that matter, here. And it gets to this idea as to whether that relationship is so broken, or more importantly, whether it's reached a stage where it is going to have a material impact on how the PGA operates.
And what we're seeing right now is that the Live Golf has not been afraid to pull golfers away from the PGA Tour. I mean, their last guy was a $300 million deal. And so the question that I think a lot of fans and players are asking, and executives are asking, is how long is Live going to be patient with this? December 31st, then they get SSG involved, which is the business consortium with American sports owners. And so we just have to wait and see.
So I want to ask you about that, the SSG, the Strategic Sports Group. It's a group of Wall Street type investors, a lot of PE guys. They, donated or put in, not donated, invested $1.5 billion or $3 billion, I'm not sure which is the number because it comes in stages, to the PGA, essentially giving them a lifeline?
So it's a for-profit arm. The golfers have equity in this new for-profit arm, and the initial thought was that this would help it get to the finish line. But that was 60 days ago, and it was 90, and now we're 90 days since the December 31st deadline. So the question is, when does the deal get done? And if the for-profit arm was truly going to help it surpass or get to the finish line, then what's taking so long? And so I think this is just much more complicated than all parties really anticipated.
Have we heard from any of the individual golfers that they've been vocal at all about what's going on?
Oh, of course, of course. Everyone's frustrated. The best want to compete against the best, and when that's not happening, you see the fans frustrated, you see the golfers saying viewership is down, and so we're reaching a pinnacle point. If the Masters ratings are down here, then the fans have shown this isn't good enough for us, and we want it to be back together like it once was.
But the golfers are getting paid more though, right?
Yeah, but it's too fragmented. And I mean, you watch some of the Live tournaments, I mean, it's like they kind of lure you in with this idea that they have such as this big player, John, or one of these other guys, but then, he's competing against scrubs. I mean, it's like, it's like a pro-am game or something. Like, what am I watching?
Well, Live Golf doesn't have the massive media deal that the PGA Tour does. And so if they come together, then I'm sure that that's what's going to happen eventually. But right now, yes, Live Golf has some superstars, but it's the PGA Tour. It's been around forever. You ask Bloomberg Terminal readers, they would tell you that they recognized the PGA Tour before Live. And so, it just has to come together at some point, or, Live might just pull 3-4 more golfers for, who knows, $500 million combined. They spend a lot of money luring these players over.
All right, well, a lot of drama going on right now in golf, not necessarily good for the sport, but we'll see how it all plays out. Randall Williams there for us. We want to continue this conversation, I guess, go from the best of the best when it comes to golf to, just the recreational folks, the duffers out there who are saying they're actually getting rocked by higher prices at their clubs. Now, one person out there has a solution. His name is Quentin Lutz. He's a co-founder of the Outpost Club. It's a golf society with members in about 42 states and 18 different countries, kind of a concierge service. The idea here that I don't have to be limited to just one club. I don't have to be limited to just one city. I can move around. Kind of explain how this works, Quentin.
Yeah, no, we thank you for having me on, man. Appreciate it, and Scarlett, thank you. It's a real honor. The Outpost Club was started back in 2008. Invited our first members in 2010 with the intent of allowing private club golfers to go and play other courses. Just make it a little bit easier. Guys were getting tired. Guys and gals were getting tired of going to their PGA pros and asking them for favors. So it was a win-win. And as we've grown, it's really become more sort of event-centric in that, we have 75 events a year. And I think that's really been the driver in the later years as we've grown. But it's a great way to sort of extend your golf playing ability, allows you to go play all over the world and some of the best clubs that you otherwise wouldn't be able to get access to.
Is this targeted at kind of the die-hard golfers, the folks who've been doing this for a while, or is this also sort of intended to maybe help new folks who are maybe just getting introduced to that sport, maybe making it a little bit more accessible?
Yeah, no, I think accessibility is a really big point. I mean, if you look all over the world, other than the United States, golf is rather accessible. I mean, there are not that many private clubs in other parts of the world. And the United States, we started private club world back in 1950 when the pros started attaching their names to different clubs. And that sort of carried the day, and it's what we have today. And the Outpost Club was a solution to that. But it's more than that, really it's the camaraderie, it's the fellowship, it's all of those things and getting like-minded people together to experience some of these great places has been fun to be a part of. It's really grown more than I could have imagined.
Quentin, you mentioned that you founded the Outpost Club in 2008. It was basically after the 2008 recession when a lot of golf clubs were kind of hurting economically and needed to boost their revenue and needed to find different ways to do so. We know in 2020 with the pandemic, that provided a different context, a different backdrop for golf clubs. Did that kind of turbocharge what you had in mind for the Outpost Club, given the growth and interest in the sport?
Yeah, I mean, the pandemic was really good for a couple of industries. I mean, golf being one of them, boating being another. But golf was really a catalyst because it got people outside. It had the natural social distancing, all that sort of thing. It had all those components, and it was a time where we actually had some growth, and we were all concerned in the beginning. But the game of golf really grew during that period. So I think it was a good thing for the game. It certainly became more popular. You've got a lot of people that were not playing golf. You got them back on the course.
Yeah.
So from that extent, it was definitely a win-win.
Yeah, and before the pandemic, there was all kinds of talk about worrying that golf was no longer reaching this younger audience and needed to find a way to really innovate and attract a younger demographic. Can you tell us a little bit about the demographics of those who are signing up with the Outpost Club now? Male, female, where they're based, Europe, Asia, the U.S.?
Yeah, no, it's all across the board, Scarlett. I would say that, the demographic, I think average age is sort of probably in the upper 40s, early 50s. And I think once you become an empty nester, you have the disposable income to sort of travel a little bit more and get outside of your sort of your normal network. So that's probably, but we're getting you're getting a lot of younger players as well. I mean, it's a nice solution for people that don't want to be just a member of one club. They want to be able to experience courses all around the world. So as far as our membership, I mean, we've got, I'd say probably 80% is US based and 85% is probably US based and 10 to 15% international. But, we love the international members. We just took a whole group down to Argentina to play a match with the Jockey Club, and it was absolutely fabulous. I mean, we couldn't have asked for better weather, and just an amazing experience for everyone involved, both the people at the Jockey Club and us. So it was great.
Well, I'm jealous. You guys got another auction. I think it's starting next week?
Yeah. It's exciting. I mean, one of the things that we didn't talk about was the Outpost Foundation. That's one of the things I'm probably most proud of, which is a foundation that we started to help kids get through college, kids that are in the golf industry. We've actually put together 65 scholarships for these kids, and we're looking to do a lot more. We've raised over $1 million for kids and young adults in the golf industry.
All right, Quentin, really appreciate your joining us today. Quentin Lutz is co-founder of the Outpost Club, joining us right now from Mexico. And Romain, the way that the Outpost Club works, where you don't need to be a member at one golf club, but you're a member of a network of golf clubs, is kind of like the Epic Pass for skiers.
Yeah, it's kind of cool. I guess as long as you kind of keep it under control, because we all know what happened with the Epic Pass. But I do like it from the perspective, too, of just kind of exposing a lot of people to the sport in a way that, it's hard. I mean, golf can be intimidating for a lot of people. Clubs are expensive. Every club has its own culture. You're not going to fit in. So I think this kind of helps people kind of ease into it and find their way.
Yeah, you can kind of sample things around the world. All right, let's take a look at how markets closed on the day. Down day. In fact, we haven't seen these kinds of market moves in a while. Off its lows. At one point, it was down 1.2, 1.3%, but the S&P 500 losing about 1%. But look at that move in the 10-year yield. You had a pretty dismal auction as well, 4.54% there. We shot past 4.5% really quickly. I guess the next stop is 5%, it feels like.
And I just want to point out real quickly, not on the board there, but keep an eye on dollar yen right now, hitting 153 here, a big spike up here as we head into the morning session over there in Asia, and we close out the U.S. trading session.
Is there going to be any intervention? That's the question. This is the close on Bloomberg. Japanese Prime Minister Kishida visiting President Biden in Washington today. The two discussed cooperation in the South China Sea, investments in AI, even plans to send a Japanese astronaut to the moon. For more, let's bring in Bloomberg Balance of Power co-host Kelly Lyons in Washington. So, Kelly, all of these details are meant to really underscore how strong the relationship is between the U.S. and Japan, even as there are a lot of tensions underneath that may not have necessarily gotten addressed.
Yeah, that's right, Scarlett. Really, this is all aimed at strengthening the relationship between the U.S. and Japan, some through specific mechanisms that were announced this week. You've mentioned investments and partnerships and technologies, including artificial intelligence as well as space, with those astronauts set to join a NASA lunar mission. But by and large, it was really emphasized, especially in the press conference that President Biden and Prime Minister Kishida conducted, that this is a defensive alliance. And they talked about joint military exercises that they could do together with the United Kingdom, and the fact that they really are aimed at countering China and other potential threats like North Korea if necessary, really focusing on that aspect of what is a very close U.S. ally. Of course, the nature of Japan being a U.S. ally, though, is what has made some of the areas of consternation even more interesting. Specifically, of course, I'm referring to that $14 billion deal Japanese steel giant Nippon attempting to buy U.S. steel, which President Biden has already come out against, saying that it should stay in domestic hands. Domestic ownership should still be the same, as he really tries to have the back of the United Steel Workers. He said in a press conference today, when he was asked a question about that by our very own Jordan Fabian, that he stands by his commitment to the American steelworkers. He did not double down on the language calling for it to stay in domestic hands, but still, it doesn't seem that much has changed about his stance even after the meeting with Prime Minister Kishida today. And I would note that all the Prime Minister really said about this is that he hopes the talks continue positively.
So the net effect of all this meeting today and really over the last couple of days here, Kaylee, does it move the needle at all in our relationship with Japan?
Well, there have been some incremental developments, sure, in areas like I mentioned, but by and large, this wasn't so much about needing a reset of a relationship than just showing that the relationship exists and that these are two allies that will stand united in this Pacific theater in particular. Japan, of course, is the most important ally that the U.S. has as they are looking to the South China Sea and countering any threats that China may pose. What maybe could be more newsy is it's noteworthy that Kishida is also going to be addressing Congress tomorrow, and there have been a number of lawmakers who, like Biden, Biden have come out against the U.S. steel deal, would not like to see it go forward, have called outright for it to be blocked, which the president has not done. So you could see some news in that regard from Capitol Hill tomorrow.
Kayleigh Lyons, co-host of Balance of Power, 5 p.m. every day, Washington time, right here on Bloomberg Television. And during that press conference, we got a chance to hear from President Biden, who was asked about the battle with inflation and how it's getting a bit tougher. Here's what he had to say.
We have dramatically reduced inflation from 9% down to close to 3%. We're in a situation where we're better situated than we were when we took office, where inflation was skyrocketing. And we have a plan to deal with it, whereas the opposition, my opposition, talks about two things. They just want to cut taxes for the wealthy and raise taxes on other people. And so I think they have no plan. Our plan is one I think is still sustainable.
The president speaking a little bit earlier about that inflation report and what he says he's doing to actually curb inflation. Bloomberg economics correspondent Enda Curran joining us right now to dissect that. And when you go through this CPI report, car insurance, personal care products, apparel, meat, eggs, these aren't ephemeral products. These are the products that everybody sees every day when they go out and about with their lives, and what they're continuing to see, Enda, are higher prices. Is this going to be a problem for the president heading into the election?
I think it's coming at a pretty bad time in the political cycle, no question. It's the third month in a row now that inflation has been higher than expected. It's kind of moving beyond the stage where you can make excuses that it's shelter-driven costs or it's gasoline-related costs. As you mentioned, it's the kind of stuff that people now, the staples that people spend their money on every day in the week. Food price increases have slowed fairly markedly, but as you say, across the board, plenty of sticker shock elsewhere. And that is feeding into the mood among the electorate. We know they've been consistently grumpy in the opinion polls about the state of the economy. And now, as you mentioned, President Biden making those remarks on rate cuts today. It's unusual for a president really to be commenting on what the Fed might be doing, but he seems to be saying there's still scope for a rate cut this year, making the point that inflation's come down from 9% to 3%. The question, I suppose, is whether or not that rate cut will come on time for the election in November.
Yeah, disinflation is a good thing, but consumers would probably prefer deflation, where prices are actually falling as opposed to just rising more slowly. In terms of what the president can actually do, what the White House can do, we've seen in the past that releasing barrels from the Strategic Petroleum Reserve is potentially one option. Is gas prices going to be something where the White House is going to train its focus?
I think it's going to be a very topical area to keep an eye on, because as gas price of oil per barrel heading towards $100, that will certainly raise questions about what the US can do in terms of its energy reserves. Heading into the summer driving season, people are already complaining and noticing about the price of gasoline at pumps. That's one area. On the shelter housing costs, of course, the government there is talking about some measures for relief for new mortgage holders or taking a loan to buy a new home. But again, within 6-7 months of election, can they really turn around the shortage of housing stock? That's probably unlikely. And then when you go across the sweep of other products where prices are going higher, the administration has been talking a lot about grocery prices and say they're putting pressure on supermarkets like there. But when you look at the other sectors, the price of car insurance, price of getting your car fixed, furniture costs, healthcare costs, they're all going in the wrong direction.
And like I said, the solutions to that end aren't something you can just kind of roll out in 5 or 6 months here. And that presents the conundrum. We've talked a lot over the years about this idea that a lot of people make their decisions about who they're going to vote for based on what the economy looks like, not in November, but quite frankly, in the months leading up to it, particularly in the spring and summer. And it raises the question that this sort of bully pulpit, and more importantly, the tone that he's taken towards corporations, the idea that this inflation problem isn't something that's born out of policy. It's born out of greedy corporations taking all your stuff and refusing to give all those profits back to you here. Is that message going to resonate?
Well, corporates don't like being under the political spotlight. I wouldn't be surprised to see corporates play the game to some extent during an election year. But if you step back from it, economists say there are a lot of variables that play in the inflation story. There's definitely a suspicion and evidence that profiteering was part of it. But there was also that supply story, and that's continuing with companies complaining that they can't get workers, or they can't at least get the workers with skills. Mm-hmm. That's something that can't be solved overnight in a hurry. Wage pressures continue to bubble higher. There are several variables in this story that aren't necessarily just the price of goods at the local supermarket. And many of these problems are long-term and structural.
Well, you mentioned wages and workers. We know the increase in immigration is showing up in job numbers, the increase in the supply of workers, low jobless claims, or at least jobless claims staying low. Do you see signs that increased immigration is showing up in inflation data at all?
Well, it's certainly being credited, the increase of workers due to immigration is certainly being credited for taking pressure off wages going higher, preventing a wage spiral, so to speak, and is being credited for growing the workforce and by extension growing the economy, growing the revenue base. Those are the positives. Of course, the downside or the thorny aspect of immigration is that economists also question how much pressure it's putting downward on wages, especially lower income workers, and is that sector taking a hit as a result? But there's no doubt that economists are now, I think, taking a very new and fresh look at the role being played by immigration. It was underestimated last year. With the new figures that come out this year through the CBO, I think it's put a whole new focus on the debate around immigration and what it means for the economy.
All right, Bloomberg economics correspondent Enda Curran, a closer look here at that CPI report and the potential political implications here for that hot reading. All right, stick with us. We're going to set you up for what to watch over the next 24 hours. This is The Close on Bloomberg. It's been quite a day, Scarlett. I think that CPI report might have changed the trajectory for the Fed. We're going to find out over the next 24 hours whether it changes the trajectory for other central banks. We get a big decision tomorrow.
Yeah, the European Central Bank coming out with its decision at 8:15 a.m. Right now, economists expect it to hold steady at 4.5%, but signal its readiness to start cutting rates in the coming months. The interesting thing is, of course, after today's CPI report, the odds of a June rate cut in Europe fell to 80% from being fully priced in just before.
And there's a lot of questions as to whether they would start down that rate cutting cycle without the Fed doing it.
Yep.
At least our economists at Bloomberg Economics think the answer to that is yes. We do get some more economic data tomorrow out of the U.S. as well. Another inflation reading.
On the wholesale level, which is a leading indicator for the consumer prices. So certainly we'll keep a close eye on that, and jobless claims as well, which has showed the labor market remains very, very firm. Yeah,
it remains very firm. But it was kind of interesting because the report today, it really wasn't about the labor market for once. It really was just about good old-fashioned, just prices.
Right.
All right, what else we got? Well, we were talking a little bit earlier about the meeting between Joe Biden and the Japanese Prime Minister. We're going to have a trilateral summit tomorrow with the president of the Philippines.
And, I don't know how many times they're going to say the word China. I'm guessing they're not going to, but it's kind of going to hang over everyone.
I thought it was interesting to read out today how it wasn't really talked about much, right? Or at least not publicly. They didn't talk about it. I assume behind closed doors there had to have been something going on there,
Oh, absolutely.
Right? All right, we will have full coverage of that as well. And actually starting tomorrow, Scarlett, we get the Masters golf tournament.
That's right. Yeah. And of course, taking place at the Augusta National Course in Georgia. And Tiger Woods will be making his appearance. The last time he won the Masters was in 2019.
Yeah, I was looking at the odds, though. Yeah, and unfortunately, he's not gonna win.
He's got back problems.
But I was looking at the odds. Scottie Scheffler's at the top there. So not the returning champ, not Tiger Woods. It'll be interesting to see, of course, 4 days of that. I don't know, maybe we'll have coverage of that or not, depending on how we feel. But join us and you'll find out. Thanks for watching us. This is The Close on Bloomberg.